continue with government objectives and policies. Remember we said government objectives are what the government is trying to achieve within the economy. That's government objective. Examples are reduction in the unemployment rate, stable prices. These are what government wants to achieve in the economy. So how would government be able to achieve this? Government needs different policies to be able to achieve their objective. So one of government objectives, or one of the government policy is monetary policy. And when we talk about monetary policy, we're talking about interest rates and money supply. So monetary policy is a government policy that would help the economy in terms of what we purchase and what we sell as businesses. So what is interest rate itself? Interest rate is the price we pay when we borrow, or the price banks do have to pay us when we save our money. That is what interest rate is. Are you guys with me?
Yeah.
Good. So here, I already said what interest rate is. This is the price of borrowing or saving. So if interest rate increases, it has the following effects on businesses. But before we go into the effects of high interest rates, already we have to understand what interest rate is. That from the bank, the central bank of the country would set the interest rates. Mostly the central bank of the country. They are the one in charge of monetary policies.
Okay.
So they could use interest rates to correct the economy. Sometimes there might be inflation in the economy. If inflation rises in an economy, mostly if it's because of increase in aggregate demand. So we call it demand pull inflation. Demand pull inflation.
Yeah.
So this kind of inflation, if it occurs in an economy, government could use interest rate to correct it. How? Government might increase interest rates. So because if government increases interest rate, it means people will stop buying, rather they will save. Because at that point in time, the cost of borrowing will be high. So borrowers will be worse off. Savers will be better off. So money will be out of the economy because the people would start saving a lot of money. As a result, demand in the economy would fall.
Yeah.
Reducing demand through inflation. Do you see how government works now?
Yeah.
So government would use a situation, government would solve a situation by bringing up a policy to solve that situation. So that's about interest rate. So how does interest rate have an effect with businesses? So let's talk about high interest rate. For high interest rate, I wrote, borrowing becomes expensive as a result. Firms might find it difficult to finance projects through loans. If interest rate increases in the economy, that means the amount you have to pay when you borrow money from the bank will rise.
Yeah.
Do you get it?
Yeah.
As a result, businesses will find it difficult. They will find it there won't be incentive for them to borrow money.
Yeah.
Because when they do borrow, they have to pay high interest rates, which increases their expenditure. So borrowings will be less in terms of loans. So firms will not find it difficult to finance projects through loans. So whatever projects they want to do, they would rather do it out of loans. They wouldn't get loan from the bank because if they do with the loan, they have to pay high interest.
Yeah.
Do we get the point? So high interest rate will reduce businesses' investment that has to go with loan.
Okay.
Is it clear?
Yes.
The second one, firms that have existing loans have to pay more on interest, which increases their expenditure and reduces their profitability. Those businesses that have existing loans, their interest will have to increase because the interest rate has increased. If you have taken the loan before now, then maybe the interest rate was 2.5.
Yeah.
Now the interest rate has increased to 3.5. Your loan repayment, your interest that you have to pay has to come with 3.5.
Yeah.
It has to be with the rate of 3.5. So that means your interest has to increase. The interest payable has to increase. As a result, your expenses will increase. And if your expenses increases, your profitability will fall. Do you understand?
Yeah.
The third one, demand in the economy falls as consumers might not be able to borrow to increase their spending. So revenue falls for businesses. You see, it's cyclical.
Yeah.
The demand in the economy will fall. Why? You and I would not be able to borrow money to fund our spending. So as a result, we would not want to borrow, we won't be borrowing, then we won't be demanding.
Yeah.
And if we are not demanding, then businesses will not be selling.
Yeah.
So what happens to businesses? The revenue for businesses would fall. Do we understand the effects of interest rate now?
Yeah.
High interest rate on businesses.
Yeah.
Now we go to consumers. We consumers.
Mm-hmm.
How does high interest rates affect us? Number one, house owners.
Mm-hmm.
Some people, they have houses. They got their houses through mortgages. That means they have to be paying maybe monthly, monthly, mostly monthly on mortgage. Then it has to come with interest because getting a mortgage is just like you are borrowing money too. So high interest rates would affect house owners that have taken the house through mortgage. So they have to spend more on mortgages. As a result, they won't be able to spend on other aspects that are important because they have to divert their funds into making sure they pay their mortgage. Because if they don't pay their mortgage, they lose the house. Do we understand?
Yes.
The second one, demand for goods that are bought with borrowed money will fall because funding expenditure with borrowed money will be quite expensive. There are some goods that we have to borrow money for to finance them, to buy them. But if we are unable to borrow money anymore because of high interest rates, that means those products won't be available. And even if they are available, they will be expensive. As a result, it won't be affordable for consumers to buy. Goods that are used or that are financed or funded with borrowed money, their prices will be high. And if their prices are high, because they are funded with borrowed money, and those borrowed money now have high interest rates. So as a result, businesses will find it difficult to lesser the price. They have to sell at a higher price. Selling at a higher price would mean that consumers will not be able to buy at affordable prices. So consumers will not be able to afford it. And the last one, savers will benefit more as the interest on savings will be high. On the other hand, low interest rates will be worst for savers as they will have low returns on their savings. Now, high interest rates would encourage people to save more. Why? Because the price of savings has increased. So we will be able to save more. Even when you have saved before, if you have saved before, the interest rate was, for example, it was 2.5. Now the interest rate is 3.5. So you will start enjoying the interest rate because you have saved before now. And a lot of people will be attracted to saving. But if there's low interest rate, savers become worse off because the returns on their savings would be less. Do we get the point? High interest rates will make savers to be better off because at that point in time, they will have high returns on their savings. We said interest rate is the price of saving or borrowing. So if you save and there's high interest rate, your investment on savings will increase, yes or no?
Yes.
But if there's low interest rate, if you save, your return on saving will be what? Will be what? Reduce. Do you understand?
No.
You don't get it? Savers are those that have put their money into the bank. With high interest rates, they will make more money through that. But if the interest rate falls, they will make less on investment. Do we get it now?
Yes.
Right. Any question about that?
No.
Any question?
No.
Right.